market trends and forecasts, outlook for buyers and sellers, key insights from the experts. Welcome to the Hawaii Housing Report with economist Paul Brewbaker and Patrick ONeill.
Single-family homes sizzle while condos fizzle. Welcome to the Hawaii Housing Report. And as always, we're joined by Hawaii's favorite economist, Mr. Paul Brewbaker. Paul, how are you today? I'll take that as a good. Well, Paul, it's been a crazy month for economic news, and we're going to talk about words that begin with T, with R, and with I. And before we do, let's take a look at this continued divergence between this robust single-family market and this very sluggish condo market. And I'm going to pull up these statistics from the Honolulu Board of Realtors, and I want to give a shout out to Cheryl Enriquez and her team for putting these statistics together each month. They really do a great job.
Mahalo,
Okay,
Cheryl.
yeah, mahalo, Cheryl.
She hooks me up too.
Yeah, that's great. Okay, so we're going to look at active inventory, and this is going to be, I think this is the most interesting stuff that I saw this week. Okay, let's start with single family homes. This is the number of homes that were available last month in March. Compared to 2024, that's up 33%. Very good news for buyers looking for single family homes. Compared to March 2023, up 43%. So it's good news, certainly, for buyers. And I'm going to hold on the 2019 number till the end. Now, condos is where it gets wildly interesting. Here we go. Looking at last year, there are 54% more condos on the market. But check this out. There is 100% more condos on the market compared to 24 months ago.
Wow.
The condo inventory has doubled. And Paul, for someone who has not tuned into this program before, what are the things, the three or four things that are really causing this pile up of condominium inventory?
You know, in urban Honolulu's core, the vintage issue is catching up with a lot of buildings. Maintenance and operating expenses are rising. A series of natural disasters, wildfires, and hurricanes in recent years has caused insurance premia to suddenly increase. And then there seems to be a bit of a stigma associated with the uncertainty regarding short-term rental regulation under the city's new, arrangements under what was called Bill 19 about 6 years ago.
Yes, yeah, and you've done a lot of work on that, on the short-term rental thing. But
Well, the
let's,
neighbor
yeah,
islands are all kind of confronting the issue in their communities as well.
right. Yeah. And for sure the vintage is an issue. Many of the buildings are 50 years old. I think you had a statistic one time, like 80% of our buildings are built before 1980 or something like that.
Something like that, yeah.
Yeah, it's really affected the affordability. And to your point on the short-term rental, there's a hesitation from investors for sure in the condo market. Okay, well, let's start with the T word, tariffs. We don't have to go into this in great detail. Yikes, tariffs. Tell me your perspective, economist Paul Brewbaker, on tariffs. Where do we stand? How's it going to affect us here in Hawaii?
Yeah, as is well known, the new administration, Trump's repeat at the presidency, um, has focused in terms of trade policy around tariffs, and it did in the first his first administration as well. But I think what surprised everybody is the sheer magnitude of what he has proposed, far beyond what anybody thought might have been plausible, and also I have to say, not entirely grounded in, let's call it, the economic consensus. If you talk to people in my field, and in an historical context, what the Trump administration has put forward and evidently is negotiating with other countries about right now is something along the lines we haven't seen for 150 years. So we spent a lot of the last century working these tariffs down, and now the proposal is to take the effective tariff rate, much higher than we've seen in the past. The problem is that the uncertainty, we don't know what's going to end up being the actual tariffs, but the uncertainty is driving people crazy. And you can actually measure that. We have these machine learning models now that can go out and scan the globe's, media sources for signs that people are talking about this issue. So this is an index for uncertainty about trade policy per se. And you can see clearly the big jump since the inauguration 3 months ago. So it's, it's on people's minds. There's concern about it, and it's creating uncertainty that is weighing on investors' expectation, and frankly, I think weighing a little bit on global economic growth prospects.
No, no, no question about it. Well, let me go to the next big word. Begins with an R. Recession. It's now being thrown around again. Last time it was thrown around quite a bit by everybody from Jamie Dimon to anyone else who could get on the television program. You said no way, not going to
Yeah.
happen. What are your
I,
thoughts now, like in the next 12 months?
yeah, well, past performance is no guarantee of future, blah, blah, blah. So just because I turned out to be on the right side of that issue a few years ago, people were saying there was going to be a recession because of the Fed's increase in interest rates to tamp down the inflation that had followed the pandemic. And I thought the US had a good shot at a soft landing, that is, a reduction in inflation without precipitating a recession and a rise in unemployment. And we were on that glide path right through December of last year. If you look at the Fed meeting announcement, the forecast that the Fed publishes quarterly of their own expectations, but by March, that all changed. Language of the Fed changed to sort of wait and see. We're not sure what's happening. And economists broadly assessment of the probability of recession has dramatically changed from soft landing to the risk of, you know, a pitfall, so to speak.
So what
It's a
about you? What
little,
about you, Paul Brubaker, today? Next
I
12
think
months
they're
of you.
I think they're better than even odds, but they're a little more complex than that because ordinarily you associate recession with falling inflation. This is a situation where the recession risk is accompanied by the risk of rising inflation because of the tariffs. So that so-called stagflation creates a dilemma for the Fed because it can only really hit one target with the
Yeah.
instruments it has at its availability.
I suspect if things started to head down that path, there'd be a quick reversal on these tariffs because that would be political suicide to let that happen.
The
Well, let's,
question is whether the
yeah,
damage already has been done.
I
Like it's a
understand.
reputation thing. I was a
Yes.
virgin, not so much now. Yeah.
I don't think anyone's buying that from you. So sorry. Um, okay, let's talk about the third letter, which is I. Let's talk about interest rates. And to do that, let's bring in
Yeah.
Anders Hostelley, state manager for guaranteed rate. Anders, great to see you again. Thanks for being
You
here.
doing? No, thank you. Thanks for having me again.
Yep, and congratulations on your new office. It was good to be there at
Oh,
the grand opening and see all
thank
the
you.
familiar faces. So well done. Okay, well, let's talk about interest rates.
Hmm.
And this has been also on a wild ride, right? We went from nearly 8% about a year ago. We got
Hmm.
down to just below or just above 6. We thought probably would dip into the fives, and now we're back up probably around 7, something like that. Where is the 30-year vanilla today? Hi, it's Patrick. If you're enjoying this content, please do give us a thumbs up below and be sure to subscribe. Thank you.
Yeah, I do my standard type of transaction with 25% down with somebody with pretty good credit. And yeah, we're, clocking in around 6.885 with a half a point thereabouts. So it's right in, line with this market survey that you have from Freddie Mac that you're showing.
6.85 with half a point.
Yeah, so
Yeah.
yeah, I mean, you kind of look at like we've been here already in the last couple of years, and the rates, like you said, went down. They've come back up a bit, but I don't know. I mean, it seems like buyers, people kind of looking, even to refinance, they're getting a little bit more used to these types of interest rates, and people aren't clamoring or saying, "Hey, when are we going to see 4% rates again?" Everyone's really, we're just hoping that we can get into the fives at some point.
Right.
Yeah.
Yeah, what a difference. And Anders, what about the VA FHA rates? Are they still substantially lower?
Yeah, they're about half a percent lower,
About
especially
half.
VA. Yeah, about half a percent. So we're looking at the low sixes right now. Yeah.
And for somebody coming in for a shorter hold period, are there any good adjustable rate product right now? Okay, get
Yeah,
any sort of a break on that?
yeah, the adjustable rates are we're about 0.5% also lower than the 30-year fixed rate. So, there's the 5, 7 to 10. If you do a 5-year, it's a little shorter term, so it's a little bit better rate than it's like a 7-year arm.
Yeah.
So yeah, there's those opportunities as well.
Yeah. And then I know you and I've talked quite a bit and with Sue Savio about the insurance issue and how that affects lending. Have there been any new workarounds for buildings that are underinsured? Is there any type of workaround from the finance side?
Yeah, well, there's still a few lenders that are willing to finance in projects that are, let's say, underinsured, that don't meet the conforming standard guidelines of being like 100% hurricane insurance, for instance.
Yes.
That comes with the price. The interest rates are quite a bit higher for those types of loans, and buildings that are underinsured.
Okay. And then finally, Anders, I know you track loan originations, rate locks as kind of a uh, harbinger of what's to come. Have you seen any changes, any upticks, any slowdowns, about the same compared to last month?
Yeah, I'd probably say it's a little bit slower than last month. It's the activity slowed down just a little bit. But of course, a
Yeah.
month ago, rates were, I mean, there was about almost 0.5% lower than today.
Right.
Yeah.
So crazy. It's just been
Yeah.
such a crazy wild ride. Well, just so that you could be wrong one more time, where do you think
Sure.
rates will be in December of this year?
I'm still
This,
hoping, thinking maybe in the high fives, but
okay. Let's remain optimistic. I'll
I
go
know
with you on
last
that.
month, yeah, I know, but
Yeah.
it's in the fingers. And, I always tell everybody, hey, look, people are always going to need to buy homes, finance homes, right? There's always going to be need for that, no matter where mortgage rates are. Now, as far as
Yes.
refinancing, that may not be, as much of that going on when rates move up. But anyway, so.
Okay. Good. Well, Anders, I thank you so much for taking the time. I really appreciate it and picking up my calls throughout the week when I got to check in with you on the rates and see what's happening. Really appreciate it. Okay, so stand by. We're going to be right back with economist Paul Brewbaker. We are going to talk real estate when we get back. So stand by. Okay, and we are back with Hawaii's favorite economist, Mr. Paul Brewbaker. Now, Paul, when we've talked about the interest rate, you have explained in detail the 10-year to the 30-year mortgage rate, excuse me, the 10-year treasury to the 30-year mortgage rate. There's a risk premium there that was historically one number, but it increased throughout COVID. What's happening to that now? And is that affecting and
So
pushing our rates to a higher level?
that's right. Historically, that spread from the 10-year note yield to the 30-year average fixed rate mortgage rate was about 1.75% or 175 basis points. But for the last couple of years, it's a technical thing, but a lot of people are trapped in 3% mortgages. And so there's there's some option
So
pricing issues
let me,
that push
let me
that.
just let me
Yeah.
just say that in layman's terms. So if the
Yeah.
10-year note is at 3%, the
Well,
30-year,
the 10-year note right now is at four, let's call it
right. I was going to use a
4.4.
simplified, I was going to use a
Oh,
simplified math.
well,
Hey,
let's tie it in with Andrew's number. It's at
okay,
4.4, but the mortgage rate is at 6.8. So that's 240 basis points. 240 used to be, or historically was, about 170. So we're
right.
about, in this case, 70 basis points too high. But what's happened in just the last couple of weeks? Sorry, I totally stole your thunder.
No, it's quite all right. I
But
just
what's
can't do
happened in the
that kind of
last,
complicated math.
yeah, I know. I usually can on the fly. I can't when I'm trying to get change at the grocery counter and I'm
Yeah.
usually getting short change. But we've talked about this earlier in this hour that the uncertainty is shown up in stock prices. You can see here in the S&P 500, which directly translates into a measure of stock market volatility. So what we're looking at right now, it's not the worst we have ever seen, but it's sort of at a second worst level. And because of that, the underlying risk-free interest rates, the 10-year yield itself, the 30-year yield, treasury note yield, treasury bond yields jumped discreetly a couple weeks ago, about 50 basis points. And as a consequence of that, a portion of what was already a lingering mortgage risk premium has been augmented by a more fundamental systemic risk premium, not an inflation risk premium, but something much more fundamental. Again, a measure of uncertainty and how it's weighing on financial markets. So the mortgage rate could have been about 6% now if it weren't for these risk premia. And we're
Right.
looking at 6.8%, could have been 6. When you think about what the forecast was, we were talking about, maybe 5.5, maybe 5%, then later this year or next year. And now that's probably going to be, if we're lucky, closer to 6 than 5.
Such a great calculation of the risk that's out there, or the perceived risk
The
that's out there, but
perception, and
the
if
perception.
the risk is mitigated, if something happens and everybody, if the flowers bloom and peace breaks out in Ukraine or I don't know, wherever, the risk premium could well subside.
Yeah. Yeah. Well, we're looking forward to that. And the double positive would be risk premium subsides and rates come down. And now we can get back into maybe something looking at rates into the fives.
The trifecta would be the underlying treasury yields come down, the mortgage risk premium that's been lingering comes down, and this underlying systemic risk. You get all three,
Right.
good to go.
Right. Sounds
I'm not
good.
betting on it, but I'm wishing
Yeah.
for it.
Okay, let's wish for it. Okay, let's shift back to housing statistics, and I always find this interesting. This is months of remaining inventory. Months of remaining inventory calculates how much inventory is on the market against the absorption rate. And Paul, we've talked in the past. General equilibrium, just as a place to look at, is
Yep.
around 4.5 months of remaining
Mm.
inventory. Anything above that is a buyer's market. Anything below that is a seller's market. So let's shift over again to the statistics from the Honolulu Board of Realtors. And I'm just going to fast forward to the punchline on this. We can see the figures going back to 2019 pre-pandemic, and we can see things sort of tracking a little bit. 2021, it kind of jumps a bit, but then this is where we are right now today. 3.3 months remaining inventory for a single family home, clearly a seller's market. And condos at 6.2, this is clearly a buyer's market. And this is part of what we were talking about before, right? This big pile up of inventory. It's all happening, right? And if we look at it, this is just another way to look at it. The red line being the equilibrium line, the 4.5 months remaining inventory. And condos look like they're just heading straight up, where single family home really is tracking consistently below that number.
Yeah, those are annual data. Let me show you what the monthly data look like when you seasonally adjust it. Talk about an explosion of inventories in the condo segment, up an inventory pileup, so to speak. Little bit of a pileup in single family. We're looking at 3.5 months instead of 3 months. But man, going over 6 months remaining on the way to 7. That's kind
Yeah.
of
It's it's been
we're
a
starting
while.
to be a concern in the condo segment.
Yeah. And when Cheryl Enrique has sent that information, it's hard to find anything at those levels. Very interesting. Okay, let's shift over and take a look at pricing then. Okay, year to date median pricing, and let's start off with single family homes, and we can see the median price. This is the year to date price at 150. And I'll just note there was a really big sale on Kahala Avenue this past
Ah,
month, over 65 million, which did affect this. It does affect the pricing, probably a percentage or so on the single family home. On the year to date compared to 2023, home sales up about 12%. And now we shift over to our condo side. So 510 year to date median price, flat, up 1% compared to 2024. And if we look at year to date, flat compared to 2 years ago. And then this really has been the difference, right? Single family homes continuing to track positive growth. Condos have been flat. And in many places, we're seeing deceleration in the pricing. Anything you want to add to that?
you bet. I mean, we've been looking at this for quite a while now, so it is important to recognize that there's something fundamentally different going on in the single family home space where valuations are rising. There's an overshoot after the pandemic. Here's the COVID event. Um, a bit of an overshoot. Things settled back, but now, as you say, they seem to be on track. They're appreciating at the same pace they were pre-pandemic, although it's upshifted, and that's something we ought to think about separately. But in the condo segment, this kind of flat drift off the old pre-pandemic trajectory starting to be of real concern here. I mean, it's a relatively affordable segment. Nothing's strictly speaking affordable in Hawaii, but there's an opportunity there for people looking for urban core dwelling, and anybody that doesn't have 65 million lying around to buy a house in Kahala. Um, Still, when you pair it with the inventory buildup and obviously some of the other concerns we've talked about, it is a bit of a mystery why the condo segment is lagging so much at a time when the single family market segment seems to have reconnected with its, the pre-pandemic normal trajectory.
Yes. And would you, so thinking about that, and let's push ourselves out 1 year from today, do you see condo market at some point breathing some life back into itself? Do you think this is going to keep lingering?
I mean, so there is a technical thing that could be a factor in the next few years. Um, in the last decade, we did have a surge in kind of, I think of it as the new urbanism. You recall in about 2015, a bunch of projects that had been lined up for a while actually moved forward in Kaka'ako, in the Kapiolani, Keamoku corridor. And so, the first round of buyers in those units may not have come back into the market. There's always a possibility that as they become a more part of the normal condo resale inventory, their newness and higher valuations will have a little impact. But again, that's a technical impact. Um, I think there's something deeper at work in the condo segment, and we should spend some time thinking about it. The flip side,
Yeah.
of course, is that there's an opportunity. There remains a relatively, I mean, not absolutely, but a relatively affordable alternative in that, urban core market that the condos dominate.
Yeah, for sure. And then, Paul, what about single family homes? You're looking out 1 year from now, I think continue to track in that five, 4.5, five
Yeah, my
plus
best guess
price.
is 4 to 5%. Kind of can't lean against that wind. I mean, there's not that much production. And so sort of what you see is what you get in this market.
Yeah.
There's not a lot of population growth, there's not a lot of household formation, but we've been producing at such low volumes for so long that
Yes.
this tight housing market is not looking at anything approaching a glut.
Yes. Okay. Well, let's, as long as we're talking about predictions 1 year out from now, let's do interest rate. What do you think the interest rate will be 1 year from today?
Well, I'm not as optimistic. I've had faith in the trajectory of the policy rate, the Fed funds overnight rate, going to about a 3% handle, and the yield on the 10-year Treasury notes settling at maybe four, let's call it 4%, just to make up a number, which should give you a mortgage rate in normal times in a range of 5.5 to 6%. But that all seems to be stacking up. There's a risk that the Fed might not be able to take the rate down because of the possibility of inflation coming from tariffs. There's a there's a risk premium in the mortgage pricing that just hasn't dissipated. We would have thought it was going to, and now there's this additional systemic risk premium. So we're at what? Let's call it 6.75. We should be so lucky to see a 6.25 30-year mortgage rate by the end of this year. And I hope we will be. Um, but it's a much tougher call for me to get to 575 for the
Yeah.
30-year mortgage, which I was kind
Yeah.
of thinking we had a shot at,
Yeah.
and not so
Yeah.
much anymore.
Not looking so good. All right. Well, Paul, thank you very, very much for all the insights today and sharing your information. And can't wait to hear what happens in the next 30 days with Donald Trump. Never a dull moment that you have to
Oh, wait,
admit.
I just got a message on my phone. We're
Yeah,
attacking
something
the
just
Houthis
changed.
in Yemen.
All right. Anyway, I really appreciate it. And if you're watching this and you've enjoyed this on YouTube, please hit a thumbs up below for Paul and hit subscribe so you don't miss next month's Hawaii Housing Report. So until next time, be well, be kind, and aloha.
Aloha, everybody.